Hi, and thanks for watching this Finance with Excel video. This is the first in a series of videos that we're going to do that will discuss personal income taxes. And we are going to create an Excel video that will help us to estimate and develop an approximation of what our income taxes are likely to look like when we file them. Now, just to be clear and to kind of put my disclaimer out there, I'm not claiming that I'm doing every single element of the U.S. tax code. I'm doing a very simplified kind of overview of some of the more common elements of taxes. And it is the numbers that I will be using are what applied to the 2016 tax season. So these numbers, if you're using them to build a spreadsheet that's later than 2016, then you will likely be out of then they'll be out of date. But we're going to build the spreadsheet so that we can easily adjust the numbers as the thresholds change over time. But before we actually start building our spreadsheet, it's worthwhile to take a brief second to discuss how your taxes are calculated. So how is what you owe calculated? Well, you start out with income, and that's just what your income that you earn from your employer or your personal income. And then you have some deductions and some exemptions, and that gives you the amount of money that's taxed. So the deductions and exemptions are just money that the government says this portion of your income is not subject to taxes for a variety of different reasons. And so you take your income, you subtract your deductions and your exemptions from your income, and that is the income that that is taxed. You then take that taxed income and multiply it by the tax rate to calculate your tax liability. Now, this liability can then be further augmented by various tax credits. And so so tax credits will are just in effect negative taxes. And so your tax liability minus your taxes paid or minus your tax credits equals your taxes paid. So just a brief overview of deductions and exemptions. So what is a deduction? So the government wants to support certain activities, and so money that is spent on certain things is not taxed. So you just subtract it from your income. So some of these things are charitable contributions, and you can deduct up to 50% of your income for charitable contributions. Now that includes contributions to various charities as well as contributions to churches and religious organizations and things like that. So you can deduct up to 50% of your income through charitable contributions. Now, retirement, 401k and IRA retirement contributions up to $18,000 for a 401k and $5,500 for an IRA. It's actually the 401k and IRA is a little bit higher if you're older. They have catch-up thresholds, but we're just going to kind of deal with the base level here. Student loan interest can be deducted up to $2,500 if your income is below a given threshold. Your home mortgage interest can also be deducted up to $1 million in mortgage value, and state and local taxes are also deducted from your income. Now, exemptions, so exemptions is just a flat rate of, in 2016, $4,050 per person in the household of your income is just exempt from taxes. And so you just take the number of people in your household, multiply it by 4,050 and subtract that from your income, and that is not taxed. Now, one thing to note is that your income can never be less than zero. So your taxed income can never be less than zero. So it's going to be the maximum of income minus deductions and exemptions and zero. So you can never have a negative taxed income. Now, credits. Credits are in effect negative taxes. This is money that the government returns to you. If your credits exceed your tax liability, then you end up paying negative taxes, meaning that the government ends up paying you money. So the three common tax credits, and there are a plethora of tax credits out there, is the child care tax credit, the child tax credit, and the earned income tax credit. And these are the three tax credits that we're going to be discussing in this round of videos. So lastly, there are three ways to file your taxes, and single, head of household, and married filing joint. And the difference between these three ways is determined by the thresholds that you use. And generally, single is for people who are single and do not have children. Head of household is commonly filed by people who are single but have children, and married filing joint is for people who are married and want to file their income taxes together. And what it does is it affects the thresholds that that the government applies to the various things that you have. So there are also other taxes that you pay. This is not the only thing. So you have a Social Security tax, a Medicare tax, state income tax, and property tax. Now, Social Security and Medicare taxes are generally paid before you do your deductions, and it's 6.2% of your income, and then your employer also has to pay 6.2%. Or if you're self-employed, you have to pay 12.4% up to a threshold, at which point you no longer pay Social Security tax. For Medicare tax, it's 1.45% for you and 1.45% for your employer. And if you're self-employed, then it's all paid by you. State income tax varies by state, and there's also some states that don't charge a state income tax. And then there's property taxes, which are generally collected by the city or county, and these vary across communities. So with that very base overview, let's start building a workbook that will help us to get an estimate of what our taxes are. Remember, this is an estimate. This is no guarantee that this is exactly what the government says that your taxes are going to end up being. But with that caveat in mind, let's go to work. Okay, so this is the outline of the workbook that we're going to start working with here, and we'll walk through this as we go, and we can build it up together. So the type of filing, the type of filing determines the thresholds that you're subject to for various deductions and tax credits and things like that. There are three different ways to file: married, joint, head of household, and single. And over here, I've put married, joint, head of household, and single in this box. Now what we want to do right here is create a drop-down box, as you can see, like I've done right there, which will only let me put the values that are in this box in this cell. Now the reason why I do that is because in a lot of cases I'm going to have to reference whether or not this is an S, an HH, or an MJ in order to pull the appropriate threshold out for us to compute our taxes. So the way to do that, to get a drop-down box, is to click on the cell where you want the drop-down box to be. Go to Data, then go to Data Validation, and then click on this drop-down box and click on List. Then it'll ask you, well, where do you want this list to be? Highlight where you want the list to be, and then click OK. Now, if we click on this drop-down arrow, it'll tell us what we're allowed to have in the box. I'm going to leave it as, so the reason why I put select in there, and just notice when you put select in, when you type it in, you have to put a parentheses in front of it, because if you don't, it errors on you, and it says, hey, that's an equation. You can't start an equation with the way you did it. Because it thinks that's a minus sign. So you have to just put a parentheses in front of it, so that way the Excel knows that this is text. And so now we can pick the type of filing status. Now, married joint is if you're married and filing your taxes together. Head of household is if you're filing individually but you have dependents, and single is if you're filing individually and you do not have any dependents. So the next thing we need to know is we need to know the number of dependents under 17, because that's going to affect your some of your tax credits, and then obviously how much taxable income you earned in a given year. So just for kind of illustration's sake, I'm going to put single in here, and if you're single, you have to put 0 for both of these, and then our taxable income is going to be let's just put $60,000 in here. So you suppose you make $60,000 and you're single, what is going to be? Now, before the government computes how much you actually owe on this money, you get to deduct certain amounts of your income for various different things: charity, housing interest, state income tax, state property tax. So here you're going to put your charitable contribution. So let's say I donated $1,000 to a charity or church or something like that throughout the year. That would be a charitable contribution. If I own a house, then my housing mortgage up to $1 million is also tax deductible. But let's just say I don't own a house, so therefore I get no housing mortgage. and I don't have any state property tax. I might have a state income tax. That depends on the states where you live. If I'm lucky enough, or however you want to say it, if I happen to live in a state with no state income tax, I'm going to obviously have zeros for all of these numbers. Okay, so now our total itemized deductions. So these are not everything on the entire planet that you can itemize, but this is a decent, these are some of the most common things that people itemize for. And generally itemizing becomes a big deal when you own a house. Because if I own a house that's $200,000 and I pay 4% interest on that house, then the first couple years I'm going to be paying around $8,000 in interest. Well, probably a little less than $8,000 in interest on that house. And so then all of a sudden that becomes, and I'm paying property taxes on the house, and so then it becomes a lot more valuable for me to itemize my deductions. But for this point right now, we're going to just say 0. So your total itemized deductions is going to equal, now you have to remember that you can't deduct 100% of your income from for charity. So I can't. So I can only deduct 50% of it. So the charitable contribution limit is 50%. So I'm going to put that over here in the charity limit, and then over here I'm going to use a statement. I'm going to say it equals the min of whatever's in here, or our income multiplied by our charity limit. And then the other thing, but the rest of these, I'm not gonna build in. If you own a home that has, if you have a mortgage for more than $1 million, I'm not gonna build that into this workbook, because so few people that are going to watch this are going to currently own a home with more than $1 million in mortgage on it. But what I'm gonna do is I'm just gonna then do that plus the sum of all of the rest of these. Now, if I tried to put in $40,000 in here, it wouldn't let me take all $40,000 out in deductions. It would only let me take $30,000 out. But let's go back to $1,000, and then this is the rest of this is just kind of the way it goes. Now, the standard deduction is going to be for me. Is going to depend on how you're filing. So a standard deduction is just basically saying, depending on how you file, we just chop this much off of your income and you don't get taxed on that. For married joint in 2016, it was $12,600. For head of household, it was $9,300, and for single, it was $6,300. So now what I need to do is I need to determine whether or not I'm going to take a standard deduction or not, or whether or not I'm going to itemize. And so the decision is simply which one is bigger, because you want to take the largest deduction. I mean, they're not going to force you to take the largest deduction. That's obviously what you want to do. So what we want is the max of whatever your itemized, of whatever your standard deduction is. And so the way we figure out our standard deduction is we're going to use a VLOOKUP command. And we're going to look up whatever our filing type is, and then the VLOOKUP command says find this value right here in this table, and bring back, once you find S in this table, bring back whatever's in column 2, and then I put false to make sure it only brings back exact matches. So give me the max of that, and which is going to give me my itemized deduction, and the max of your standard deduction, your itemized deduction. So in this case, you're better off taking an itemized deduction. So right here, what we're going to say is, I'm actually going to change this a little bit. I'm going to say if this equals VLOOKUP this, comma, and we're just using that VLOOKUP command again, comma 2, comma. So what I'm going to say is, I'm saying if this equals whatever your appropriate value is in here, then give me standard. If not, give me itemize. So what this is saying just take a standard deduction. Now, suppose I go and I buy that house that I pay $8,000 a year in house payments, and I end up paying $2,000 a year in property tax. All of a sudden, my deductions are going to be larger, and so it's going to say I want to itemize. Now, 401k contributions. 401k contributions are deductible up to a max 401k contribution of $18,000. Now, if you're older, if you're above 55, I think the number goes up a little bit. It goes up by like $5,000, but we're just going to keep this really simple, and we're just going to say $18,000. And so your IRA max contribution is just an alternative tax plan, or an alternative tax way to calculate things. And so our IRA, the max contribution is $5,500. And then, so we need to calculate. So if we contribute, let's say we contribute $4,000 to our 401k, and we don't contribute anything to our IRA. So 401k is money that you give to your retirement, that you don't end up paying taxes. You'll pay taxes on it when you pull it out in retirement, but you don't have to pay any taxes on your 401k contributions right now. Your IRA contributions are just similar to 401k. 401ks are generally employer sponsored, and IRAs, I can just go open up an IRA with my bank if I want to. Now, exemptions. To calculate exemptions, the government just says, as of 2016, $4,050 of your income per person in your household is not taxed. So if you're filing single, then your exemption is just going to be $4,050. If you're filing married joint with no kids, your exemption is going to end up being $4,050 times 2. If you're filing married joint with 3 kids, then your exemption is going to be $4,050 multiplied by 5. And so we need to compute right here what your exemption is going to actually be. And this is not going to be an input. This is going to be a formula. We don't want people to be messing with this. So what we're going to do is we're going to use a bunch of nested if statements. So we're going to say if our type of filing equals married joint, then our exemptions is just going to be our exemptions multiplied by 2 plus the number of dependents. Now, the 2 is for you and your spouse, and the number of dependents is the number of dependents in your homes. That's how many exemptions that you get. Now, if your exemption type is not married joint, then we need to figure out, then we'll ask another question. We'll say if your filing type equals head of house, then it's going to, your total exemptions is going to be your total exemptions multiplied by 1 plus the number of dependents that you claim. And lastly, and then if not, the only other option that there can be is that you're filing single. And if that's the case, then your exemption is just going to be whatever the exemption is for that. So now we have this nested if statement. So if this was my situation, and I was married joint filing with 3 kids, my personal exemption would be $20,250, and that would be income that they subtract from your income. Now, the last thing we need to know is we need to figure out how much student loan interest you can deduct. So here you just put in your student loan interest. Now, suppose I've got more than $2,500 in student loans. So I'll put in, let's say I put in $3,000 in student loan. That's above the maximum number of student loans that I can deduct. So now, what we need to figure out is what is your total deduction going to be. Now we're going to have to build a formula that helps build in these all of these thresholds right here. So the student loan income thresholds for married joint is you can claim up to $2,500 for if you're married joint up to $130,000 in income. At which point the amount of student loan interest that you can deduct tapers until at $160,000 it goes to 0. And then for single or head of household, it's 65,000, so exactly half, and it cuts at 80,000. So what we're going to need to do is we're going to need to, there we go. All right, student loan threshold. So begin taper, end taper. All right, so now we need to calculate our total deductions. So our total deductions is just going to end up being whatever our deductions are minus, now for our 401k contributions, it's going to be the min of whatever's in this number and our 401k contribution. Minus, or so that should be plus. Plus the min of our max IRA contribution and how much we actually contributed to the IRA, plus our exemptions, plus, now this is the tricky one. So we're actually going to back out for a second so we can calculate at how much of the student loan interest we can actually claim. So now right here, I'm going to scroll down a bit and I'm going to do max student loan. So you can claim $2,500 of student loan interest up until your income hits $130,000, at which point the amount of student loan interest that you can claim tapers down until your income hits whatever this end taper point is, and then it's zero after that. So what we're going to calculate is your max, or your begin and your max. Right here, we're just going to use a VLOOKUP. And in this VLOOKUP, we're going to look up whatever your filing status is, and then we're going to look it up in this table, and then we want whatever's in column 2, and then we're going to put false. So this is going to say 130,000 for this person who's, well, let's go change this back to single when 0. Okay. So now, and then your max is going to be the same thing. It's going to be the VLOOKUP, and we're going to look up your filing type in this table right here, and then bring back what's in column 3 this time, false. All right, and then your income. So your income is simply going to be whatever's right here. All right, so now let's format these. They all look nice and pretty. Okay, so what we need to do is we need to figure out which range. There are kind of 3 ranges that your income could be in. If your income's above $80,000, you get 0. If your income's below $65,000, you can claim up to $2,500. If your income is in between $65,000 and $80,000, then what we need to do is you need to calculate some fraction of the $2,500 that you can actually claim. The closer you are to the $80,000, the less of the $2,500 you're actually going to be able to be allowed to claim. So the way we compute this is we just have to basically compute what fraction of the way between $65,000 and $80,000 is your income. So then your fraction, so I'm just going to put fraction here, is going to equal $80,000 minus your income divided by $80,000 minus $65,000. And then we want to put this into percents. So now let's change this real quick. So right now this is telling us 133%. Well, that's because right now our income is below this threshold, and so you can claim the max. So the fraction that you can actually claim is going to end up being the minimum of whatever your fraction is and 1. So what this is going to do is, so as long as your income is below $80,000, this will tell you what fraction of the $2,500 you can actually claim. However, what if your income goes above $80,000? Right now, this is saying you can claim negative 33%. So I'm just going to adjust this statement a little bit by just saying if your income is greater than your max threshold, then it's just going to be a 0. If not, then give me what we computed before. So now this right here will tell us what fraction of the $2,500 we can claim. So your claim, so student loan interest that is claimable is going to equal whatever that number is multiplied by $2,500. So in this case, if your income is $85,000, you couldn't claim any. But let's go back to the $60,000 case. So now it says, see, you can claim 100%. So let's go back to our total deductions and let's figure out what our total deductions is going to end up equaling. Because now we know how much of our student loan interest we can actually deduct. So we're going to say equals, and then we're going to say our deductions plus the min of our 401k contribution and our max 401k contribution plus the min of our IRA contribution plus our IRA max plus exemptions plus the min, plus the min of the amount of student loan interest that we have and the amount that the maximum amount that we're allowed to claim. So we can see that this person right here is going to be able to deduct $27,000 of their income. And now the way that breaks down is they get to deduct $11,000 for itemized deductions, and then they get to deduct an additional $11,000 for their 401k contributions. But you'll also notice that I made a little mistake right here. It's not the minimum of the sum of those, it's the minimum of those two. So there was a little bit of a mistake in mine. But we can see now in this situation, this person has a total deduction of $15,000 if they've got zeros here, and then this is what they put there. So now we can put in any numbers that we want. So if we are married filing joint and we've got 2 kids under 17 and we make $60,000 and we have these charitable contributions, actually in this case we're still going to want to take a standard deduction. We're going to contribute $4,000 a year to our 401k, nothing to our IRA. Our exemptions are going to be that much, and let's say we've got $1,500 in student loans. This is going to be our total deductions, which means that now, last but not least, we can say your taxable or taxed income is just going to equal your income minus whatever your taxes are. So you're only actually liable for taxes if this were your situation on $25,000 of your income. So next time we're going to figure out how much you actually are going to need to pay on this $25,000 in income.